Yes, once again, I'm Paul Rogge, and I'm a graduate of both the BBA program here and the MBA program. And after I graduated from the MBA program here, I was hired into AIM. Gary Crum, who built this auditorium, was my boss. And by the way, who here is an MBA student? If you can just show a hand. By the way, and for the record, when I graduated, you know how they publish a survey that says what the low salary was and what the high salary was for your class? I had the lowest salary. I knew my number, I knew what I had put on that survey, and I could tell that was me. So if you're ever wondering, oh, who's that poor guy at the bottom? That was me. But after 6 months of working at AIM, I was promoted to being a portfolio manager and launched their first international fund. And so my message kind of to you is to don't worry about your starting salary. Get involved with something you love doing, and things will work out from there. So it's kind of my 2 cents so much on your career planning, I guess. Today I'm taking a slightly different approach than the typical economic presentation. I'm going to present more like an investment case. I'm going to speak about how the current investment climate really kind of fits in with what I've kind of built as my investment theory that's really guided me over the last 30 years. I'll start talking about the 2 major lessons I learned about investing here at the University of Texas. And then I'll talk about how that framework really helped guide me to be overweight in technology and emerging markets during the 1990s and 2000s, and why that same kind of framework of thinking is what's taking me into kind of the inflation camp now. Yes, I am a one-armed economist. I believe in inflation. So my first lesson, relative inflation is important. Most of the commentary you hear about inflation, people are talking about the absolute level of prices. But at the University of Texas, I studied relative inflation of raw materials. Raw materials are things like commodities, versus finished goods. That might sound familiar. We both had the same professor, Walt Rostow. The price level of economic inputs versus outputs and what drives internal inflation was the key question for me. And this is a quote from Dr. Rostow. He was really my mentor here. National Security Advisor to LBJ and Kennedy, a renowned U.S. historian. He did a lot of work on relative inflation, not just the absolute level, and he researched when and why there are various raw material inflation periods in the U.S. and how those movements were tied to industrialization across the U.S. When I combined what I learned here in the MBA program with what I learned at the economics department from Walt Rostow, it really helped me a lot in managing money around the globe. If I could figure out where input costs were going, I could figure out where margins were going. And if I could figure out where margins were going, I could figure out where to invest. And that was really kind of my guiding light, so to speak. So if you look at what Walt did, he traced out that relative movement and relative peaks in raw material prices as the U.S. industrialized. So he started back in 1789, I think, actually. And we trekked through a peak in raw material prices as far back as 1820. That's also coincided with profitability. We looked at the raw material price peak in 1868 at the end of the Civil War in the cotton industry. And it goes on, even up to 1981 when we had that oil peak. That really set the stage for how I view the world. And so my first paper I wrote for Dr. Rostow way back in 1989, to completely date myself, was about the cotton industry in the 1830s. That sounds kind of obscure to really be looking at that when you're thinking of what inflation is. That's a pure cycle of industrialization. Industrialization of textile production radically lowered the production cost of cloth. Prices of finished goods actually fell at that time period. Mass production techniques led to dramatic decreases in the cost of cotton textiles versus the old way of doing things, which is just one guy in a loom. And that kind of makes sense, I think, intuitive sense to you, that technology is a big driver in lowering the costs of those finished goods. And at the same time, other new technologies in the 1830s came out. That was when railroads were rolled out. That's when canals started to connect the U.S., and that allowed us to have large increases in raw materials also produced because we opened up new lands, and new cotton areas came in. So you actually had this period of deflation, I think fairly similar to what we've seen over the past 30 years, which were driven by technology and new areas being opened up. Also, if you think about what I've just talked about and a little bit of what Julie talked about, this is an instant that's kind of different from what you learn in your freshman economics class. Because oddly enough, in order for the supply of a good to go up, usually the price has to go up, right? That's what we're taught with supply and demand curves. But with technology, I would argue you get a downward sloping supply curve. As the number of goods increases, the price actually falls. And so it's a different kind of economics or a different way of looking at the same economics. Also, I think I have to add too, that during that time period in the 1830s, 40s, and 50s, workers that were in those factories all of a sudden became the new consumers. And that once again added to more demand as people were making more money because it was incredibly more profitable to make cloth from a factory. Those factory workers then made money, brought that home, and they could buy their own goods. And so there's a circular quality to that, and that's the Industrial Revolution in a nutshell, so to speak. So what drives this price movement? Technological improvements, touched on this briefly before. I saw the new industrial efficiencies in emerging markets and in China when I started at AIM. And that was very similar to the cotton industry. And so then I really kind of concluded this was a new industrial revolution to get behind. Let's go to the next slide. And so what's interesting too is if you look back on financial markets, that same type of raw material inflation you can see being active in markets. What's striking to me is if you look at investment returns, these raw material cycles are clear in those red lines. That's the time period where you had relative raw material inflation. And this chart comes to us from Bank of America. When the line is rising, real assets, which are generally here a combination of commodities and real estate, outperform financial assets, which is a 60-40 mix of equities and bonds. So when the line is rising, real assets are outperforming. When the line is falling, financial assets are outperforming. Well, you see the line has gone down dramatically since the 1981 peak in oil. We've had a historic relative outperformance of financial assets. But looking forward, with a view of what Rostow talked about, we're very likely, I think, headed to a period of raw material inflation. And that, I think, is a spark that could set off inflation across the entire economy. Let's go. Well, that kind of leads to the second major question, or major thing I think I learned here at the University of Texas. And now, this sounds a bit strange, but there is potential energy in markets, and there's kinetic energy in markets. And I know it sounds a bit strange, and I think most of you are probably trying to remember your 6th grade science class going, what is potential energy and what's kinetic energy? I'll give you a quick refresher. I've learned to think of financial markets in these terms, potential and kinetic. Equities as an investment must have valid fundamentals. There has to be potential energy for that idea to work out, for that process to work out. But they also need a catalyst to unlock that value. That's where it's transferred from potential to kinetic energy. There are plenty of cheap stocks out there. Throughout the 90s, many manufacturing cyclicals in the 90s were always cheap, and they remained cheap. They didn't have a catalyst because they're increasingly being beat up by Asian manufacturers. This concept is also applicable, especially in commodity markets. When you think of commodities, the supply-demand balance is quite different than equities. The price of a commodity is priced according to the last unit that is needed and required for an operation to happen. That's very different than equity markets. Equities can always be priced as a trade-off between different companies, between equities and bonds. It's a relative valuation argument for equities, but the price of a commodity is set by that last barrel of oil needed, by that last bushel of grain which is actually required. There's no substitute for another commodity often. This is why commodity prices can be much more volatile than equity prices. If you also look at economics, we had a little talk about how we printed a little bit of money over the past few years. I would argue this is potential energy in the market, in the economy. More recently, you've had this huge expansion of the monetary base in several other developed countries. When central banks moved towards the printing of money, many investors expected immediate inflation. But as Julia pointed out, that didn't happen. We had this huge increase in monetary policy, in the monetary base and monetary aggregates, but as she pointed out, the velocity of the money fell. Here. Much of the newly printed money was not loaned out. It was simply saved in excess reserves in the banking system and showed up as a reduction in money velocity. This is why we don't see such strong inflation right now. Velocity fell, the loaning of money in the banking system, the turnover of that money declined, and several things will cause, I think, the velocity of money to start ticking up. And that's where I think inflation really takes hold. Although we still have a business cycle, in fact, in the 60s and 70s, we still had a business cycle then. And that will have an impact here, but I think the secular move towards inflation is put in place through the increase in velocity. So to kind of conclude that second thought, monetary conditions are a great potential for it, but is necessary to have kinetic energy to move and put that inflation in process. If you look back through a history of inflation rates in the US, once again, those red arrows that I point out as times where you had raw material inflation, that's where central banks had a problem holding inflation steady. So if you look at that, the time period from 1933 to 48, yes, that was World War II as well, but you had a huge surge in raw material prices over finished goods. Also in the same time period that Ross would point to, really going back to the early 60s until the peak in 81, that raw material wave up rippled through the economy. I think global demand is increasing. I don't think the central bank controls raw material prices. I think global raw material prices in effect will control banks going forward. Once again, showing how this shows up in financial markets, we've had this run in financial assets as that line has fallen, and I think we're set then for relatively high returns in investing in commodities and real assets. So where are we now? This is one of my favorite quotes. I'm actually from Nebraska. I think anybody who knows me within, probably 2 seconds, you know I'm from Nebraska. Will Cather is probably the most famous Nebraska author. I've loved this quote. There are only 2 or 3 human stories, and they go on repeating themselves as fiercely as if they had never happened before. Financial markets are essentially a human story. There is fundamentals, but there's also a human quality to it. And the vast majority of market actors now have never experienced inflation. I think this is a blind spot that will cause a surprise in financial markets. So, to put it in modern terms, here we go again. Over the past 40 years, since 1981, production efficiency increased dramatically through both globalization and technology. It was both the expansion of manufacturing into the emerging economies, as well as increases in the developed economies' production efficiency that drove that kind of Rostovian model, for want of a better word, since 1981 on. This process, at first during the 1980s and 90s, produced deflation and disinflation. It spread economic development around the globe. It was producing more at a cheaper price, that downward sloping supply curve. But now looking forward, instead of the steady supply of even cheaper imports coming from developing economies, cost structures are starting to rise, even in the emerging world. Developed economies are becoming the primary source of global demand, and now they supply the majority of GDP in the world as well. So they're taking center stage. This rise of the global middle class consumer, I think, is the most important development I've seen in my career. The power of global inflation is going forward, I think chiefly because of the global consumer. And this is a new secular trend. To look at the global middle-class consumer, I don't know if any of you have ever seen or looked at these kind of statistics. There's many ways to calculate this, but generally it all kind of goes to the same point. From 2000 to 2020, over 20 years, the global middle class roughly tripled. And that's defined as a country that's developing where incomes go above $6,000 a year, or they have assets, in this case, this is a Credit Suisse study they did, assets between $10,000 and $100,000. This is the point at which people become consumers because they've taken care of the basic needs they have of housing, shelter, basic clothing, and now they have an incremental extra dollar for maybe a motorcycle, or maybe they move from a motorcycle up to a car, or they move from a fire to a gas stove or a microwave. It's that demand for consumer goods and also the demand for like protein. You tend to have an extra chicken or so every week if you can afford it. That's that consumer spending. And that's where that incremental dollar goes. And so the growth of this consumer class, I think, is driving the global economy. Now, we've seen creation of 1.2 billion so far over the last 20 years. Pretty much if you look at this development statistics and you look at where economies are going, we're going to triple that number again, not in the next 20 years, but in the next 10 years. So we're talking about 3.6 billion consumers coming into activity, and 90% of them will be Asian. And that'll drive the bus on commodity prices. Let's look at a few commodities in more detail. You know, my favorite kind of commodity complex is the grain market. Maybe that's my bias being from Nebraska. I grew up on a farm there. I always like to think corn prices should be good. But as the world continues to develop, the demand for animal-based protein will increase dramatically. And where do you get animal-based protein? You get it by feeding grain to animals. So the demand for grain should go up dramatically. You know, and it will fall on the US and Brazil to supply that grain. If you look at the average farm size in India or China, it's only about 2 acres. Yet a modern functioning farm here in the US is 2,000. In Brazil, it's even larger than that. And the reason why you need larger farms is because that's where you can absorb technology. You can't use a GPS-guided tractor. You can't use precision planting on a 2-acre field in India or China, but you can in the US. So the incremental production has to come from the US and Brazil. And that focused movement and demand from the emerging world, I think, will cause grain prices to go much higher. Here's a history of Chinese corn imports and exports. You know, if you've ever heard of the Iron Rice Bowl in China, you know that they tried to keep their independence in food production really as a national security issue. This is sacred to them, that they wanted to keep food production and independence throughout the Chinese economy. And they did, really, through the 90s. You look at that in the 90s, they're the second largest producer of corn on the planet, the Chinese. But now, all of a sudden, with the increased number of chickens and hogs and cattle that they are feeding, they're having to turn to us to import grain. And you see these same types of statistics roll across India and across Asia as well. Well, looking at metals and industrial metals, the quality of ore is falling. Now, for many of the industrial metals, ore grades have been declining, in fact, for decades. For example, for copper, the average grade has declined over just the last 20 years from about 1% to 0.5% today. And this means, when you think about how does this actually affect the production of copper, this means you have to crush twice as much rock just to get the same amount of copper. You know, furthermore, there hasn't been any new real global major copper finds in the last several decades. And once found, it takes about 10 years to bring a major mine into production. So this is a huge problem for the plans of moving towards electric vehicles. Also with the further industrialization of the globe, copper wires, connectivity with electricity. I think the price of copper is going up. And this is true for other major industrial metals too. If you look at iron ore, zinc, and lead, even gold, the ore content that we're finding in mines is hitting all-time lows. So the efficiency of that whole industry is having a problem. Looking once again at oil consumption too. You know, yes, the US, I think it was almost 6% of vehicle sales in the US last year were electric vehicles. But if you look at what's going on in the emerging world, China alone, over the next 10 years, is expected to grow its annual auto sector from 25 million units to 39 million units. You know, that's an increase of nearly 15 million vehicles per year over the next 10 years. And that's more than what we sell in the United States in any year. So over the next 10 years, they're going to put enough U.S. car manufacturing demand in place in just China alone, let alone what's going on in India, let alone what's going on in other countries. So China will add those cars, although the percentage of electric vehicles sold is going to increase. I'm not negative on electric vehicles. Still, the total number of petroleum-based cars are going to go up over the next 10 years, even as electric vehicles make up a higher percentage. The numbers are just too great. So, does that bear out in commodity indexes? Now, to give you a little bit of background in commodities, this is the CRB index. This is an old index that was put together, I think, really back in the 1960s. And it's based on the weighting of that index is based on the liquidity of the underlying contracts that are traded in Chicago. So it's frankly, I think, a deeply flawed index. My brother Scott, yes, we have such fun family discussions that we discuss raw material prices and commodity indexes for our Thanksgiving meals, things like that. Well, my brother Scott created a new index for tracking commodity prices, and I think it's a great important. He made an arithmetic average rather than almost a market cap index. So here you have, like for example, that big peak back in the early 2000s was when oil went to 150 bucks a barrel. And as the price of oil went up, it became a larger part of the index, so it became self-reinforcing. My brother, on the other hand, took it down to an arithmetic average. So every day he's resetting how much of that index is in that same commodity. And he also then threw out commodities like sugar, cocoa, coffee, and orange juice. Because those are important for your morning. They're not really economic inputs that are then processed into something else. So trying to center on industrial metals, on energy, and on grains like soybeans and the soybean meal into a lot of the foods we eat on our table. So the result looks quite different. This is the Real Asset News Commodity Arithmetic Index. And you can see here that I think it tells a much better story that makes more intuitive sense to anybody that's experienced some inflation over the past few years. Notice the breakout across the commodities in the post-COVID era. This, to me, looks like Rothschild's raw material cycle coming to life. This is a broader range of 22, not 19 commodities. This includes some commodities traded really only in China, like iron ore. So it is a global commodity index as well. This process, should take years to unfold as a global economy experiences this greatest consumer boom ever conceived of. And what does this mean for money management? Who here is working on the fund also? Here, University of Texas, yes. I really am very, very thankful to see people like my daughter, Lauren, who's here. She's a first-year MBA student, and that fund being still part of what's life here at University of Texas. I was part of the initial discussions with Keith Brown and fund up, and it makes me very, very proud that is still here. But what does this mean for the changing of how you learn how to manage money? When I was here at UT, everybody talked about the foundation model, the 60-40 split, 60% equities, 40% bonds. And as inflation was falling, you got great diversification that way. Because as you headed into a recession, equities would sell off, but interest rates would go down, and so bonds would rally. So that's why you had this kind of give and take throughout time. Unfortunately, I think that give and take in the diversification's no longer going to work, because now if we head into a time not in falling prices, but in rising prices, we're going to face more problems like we saw last year when both bond and equity markets sell off. So I kind of propose what I call a 30-30-30-10. That's 30% equities and 30% bonds. So in 60% of your foundation or your pension assets, you'd still have exposure to financial assets, but you need that diversification quality, again, that you no longer have. And I think that 40%, or at least in this case 30%, if that was devoted to real assets, that gives you that trade-off then. That gives you the diversification, which should even out your returns, lower your volatility, and increase your return over time. The reason why I stuck the 10 on is I do think that there's also room for volatility strategies, selling covered calls, market neutral strategies, too, that would have a low correlation to overall markets as well. So I guess to summarize, For me, inflation is a global issue. Its roots are really in the industrialization and the development that we've seen over the past 20, 30 years. Raw material inflation, I think, is, in fact, you can call this an echo of globalization. This action caused future inflation. In fact, this action that is causing the future inflation, I think, has already happened. It's really a continuation of Rostow's raw material cycle that I learned about here. That kind of concludes my comments.